this computer. All right, fam, welcome to episode fucking 4,627, it feels like, but episode 14. Today we are talking about property education, what to know about the Aussie dream. I leave this one to the end because most people, when they start their money journey, this is where they go, right? They go straight here. And I know anyone who's a client or has talked to me long enough knows I love property, but my conversations might give you the different thought process on that. And that is only because there's so many people out there that are pitching property. I don't need to be another one, okay? It needs to be balanced because every man and his dog who knows fuck all about anything will tell you to buy property and think they know what to do. And my job is to try and balance it out because there are other options out there. Property isn't great for every strategy. It isn't great for everyone, but it is a brilliant asset nonetheless. So I always leave it to the end to try and allow people to open up their mindset and let some other things come in, right? Rather than just hitting you with the property from the start and then you just think, nah, property for the rest, that's it. I don't care about anything else. So it's the last episode before the wrap up. And we're going to talk about today and break it down a little bit. But hopefully from our other sessions on everything else, you'll understand today that you'll start to see similarities. You'll start to see opposing pros and cons that you can go, oh, okay, well, from that strategy, this is why this wouldn't work now and stuff like that. And you can also start to see where it's good and also where other things might be better that you didn't know about before. So I'm hoping that's what comes from this. That's why we've set it up this way. If you think otherwise, please let me know in the chat. Otherwise, let's get rolling. So property. So what we're going to talk about today is a couple of things we're going to touch on is what is a PPR? Does anyone know what a PPR is? Pew, pew. Principal place of residence, right? So PPR stands for principal place of residence. That is what we call the house that you live in. We've got investment properties, we've got residential, we've got commercial, we've got property funds, and we've got, I guess, brick X and stuff like that, where you can buy units, which are absolute trash. But it's another way to invest in property. Does anyone have any questions or want me to add anything to that list of what we're going to cover off on today in detail? No, beautiful. All right, let's get it. Okay, so let's start talking about what are the pros to property. I want you guys to engage. There's not a lot of us today, so I need some help today. I want you to jump in the chat and tell me what you think the pros to property are. Property as its asset class. Income, okay. Place to live, beautiful. Sort of holds value. What else? Let's go. High return on investment. Depends where you buy, I guess. All right, cool. So you guys have got some good ones in there. I'll touch base on your ones in a minute, but let's go through what I got. So biggest pro to property, biggest pro is its leverage capability. Yeah. There's no other asset you can leverage 95%. I remember the other week how some scammer got my number and was ringing everyone. They're doing it again. They're dogs. So you can't, there's no other asset that you can go and borrow, have 5% deposit and borrow the rest, right? Like it's fucking ludicrous. It's absolutely ludicrous. It is by far, without a doubt, it is its number one asset is leveraging, right? Is the amount you can borrow against the property. It's phenomenal. Not only in relation to buy the property, but in relation to what you can leverage against the property once you own it, right? It's a brilliant, brilliant asset. It's by far the biggest thing that we can utilize property for. Then secondarily to that, it's a physical asset. Now, some people would argue that this is, have it, man, I just get real comfy halfway through the session. I just legs up, my legs go numb and everything. It's all good. It's eats, bro. So we've got a physical asset. A lot of people will say that this is the number one pro. Can anyone tell me why it's not?
Because it's a physical asset.
But why? Why would that not be the number one pro?
You can't sell your ledger.
That's true, but that comes more into liquidity. That's another con. That's probably a con. The reason that physical asset isn't number one, you can rent rooms though. The reason physical asset isn't number one is because a physical asset is, and I always get these words mixed up. I think it's objective. Is objective depending on the person's own opinion, or is it subjective? Which one am I supposed to use there?
Sub.
Subjective.
Subject is opinion-based, object is facts-based?
Yeah.
Correct,
Yeah.
right. So it's subjective, right? It's all well and good to say I have a physical asset, but if nobody else likes that physical asset, right? It's like a car. If you own a shithouse car, no one wants it. It's all well and good to say it's a physical asset, but no one's going to buy it, right? So that's why it's not number one. It's not 100% guaranteed that the physical asset is going to be there as a pro its whole time. We're leveraging. You can always leverage the asset, right? But it is a massive pro. It's a physical asset. You can touch it. If the market went to absolute shit, you could break down the house and sell it for bits, right? Like sell it for parts. That is a pro, but again, it's not not number one. Another pro is it's a necessity asset, right? And to me, this is a con because I think property should never have been sold as an investment, but it is what it is. Because it is, we'll use it to its fullest advantage. But it is a necessity asset. It's like water. It's like food. Everyone needs a roof over their head. So it's always going to be there, right? It's always going to be there, people wanting and needing it. It's pretty unethical when you think about it, the fact that it's a commodity. It's something we really need, and we're making money off and profiteering off other people's misfortune not having it. So that's why I think it's a con, but that is why from a monopoly or a monetized venture that it is extremely, extremely beneficial. Next pro, it's a roof over your head. Yeah, it's a roof over your head. That's massive, right? Whether or not as an investment it went good or not, you could always move into it. Even if it's halfway across the country, you could always move into it and just have a roof over your head. So it has a secondary purpose to being investments, as long as you see it that way. Stability. Now, I showed you the other day how the volatility of property isn't really that stable, but as an asset class, generally speaking, it is stable, right? It is a stable asset class. Investment shares and stuff are stable as well, but the stability, I guess the downside and the upside of property is always going to be within a certain range, and it's always going to be relatively stable. Another huge pro is that it's an asset that you can, because of its leverage capability, it's an asset that you can lock in now at present. So buy now, pay later, right? I always joke, it's the only thing you should do buy now, pay later for. Afterpay homes, right? It's a start a business, afterpay houses. But that's the only thing that you really should buy now, pay later. You can lock in today's price and pay it off over the future, but hey, you got to pay it off in time to make sure it gets ahead of that negative compounding interest curve. But that's a huge positive. You can buy it today, but even though you probably can't afford it for another 30 years and lock in that price. And lastly, but definitely not least, is it's proven, right? It's a proven asset class. You can't argue that. I don't care who you are. And this is my problem with property spruikers, is this is all they argue, right? It's proven. Like, sure, it has proven, but past returns can't dictate future returns. But more likely, we've got to add purpose to property, right? 90% of the market in property is just there because of FOMO, right? But it is proven. It is a proven asset class, and we've got to back that. Now, looking at your pros down the side. So income, yeah, it does generate income, but when we look at it from an actual net perspective, it's not a lot of income, right? We're probably looking at a net 2% yield out of a property, which is really shitty income compared to what other things provide. It is a place to live, great. Jamie, it sort of holds value, definitely holds value. Most places do. We've got to understand, though, with property, we're pretty privileged / not privileged to where we live, in the way that you guys are in Victoria, I'm in Sydney, and there's Queensland, right? The three big sort of classes, and people seem to only ever focus on those three for stability and long-term returns because they are blue chip and they go up. But when you start looking at places like WA and Adelaide, Northern Territory, far north Queensland, they only get talked about when they have a boom. People go, I made all this money. My wife's parents have been up in Townsville since 2000. Their house 2 years ago was worth less than what it was worth in 1985, right? And it wasn't really that far. It's not a, and that's the number one garrison town in Australia of military people. That's the most amount of people move through that place. Now, don't get me wrong, rental yields were brilliant in Townsville. But you have the same people, you have people up in Townsville who are buying properties locally, listening to this property dream, that property always goes up, Hot tip, if you look at it, no, it doesn't. In those places, it doesn't always go up. So what's the benefit of property for people up there? Well, they've got to look at it as a purpose-driven thing. The benefit of people for property in suburbs where house prices don't rise that much or they're cheap is you can own your home much quicker, meaning you don't have to pay rent and shit. That's the property. So stop thinking about it as a fucking investment and start thinking about it. I can clear the need to pay for housing and then use that money for other stuff, right? This is why we need to look at every individual asset as a purpose-driven thing rather than just lump it all together. I blasted Michael Yardney, who up until about a month ago was a huge mentor and respect dude I've got in the property seminar, because he started really jumping on the FOMO bandwagon and put up one today as well about, only diversify if you're not good at anything. If you're good at it, concentrate. It's a fucking load of shit. You need to diversify.
Blasted him.
Hey?
You blasted him.
Nah, I just posted and told him that he's a fucking...
Can't you do the seminar?
Yeah.
No way.
Yeah, I rang because he's got a joint venture with our license, and I rang him and said, cut him away or I'm leaving.
Fucking hell.
That's fine.
Sold out.
He was brilliant, man. For years I've been using him for ages, and he started selling returns, and then he's just more interested in how he can get your money into his pocket, and I'm fucking off it. But there's no doubt in the world that his strategies are great and he's very good at what he does, but he's a fucking predatory marketer, and they're the lowest form of humans next to fucking pedophiles. And then he's probably one of them too. He looks like one a little bit, actually. Anyway, we'll move on. So we need to understand that when we're talking about property is very different from where to go, depending on where you are, depending on where you're looking, right? And the thing is, the property market will use average returns, and the blue chip suburbs boost up returns so nicely that it can create stability across the country, but doesn't mean property's stable, right, across the whole country. As well as in downward years when mining towns are booming, that's what props up the average balance across the other way, right? So we've got to really look at it for purpose and on an individual level. Not liquid. Yeah. So what is the con? So chuck some cons in the chat, not convicts. We'll just put Damo. Damo, you're in the chat. You fucking convict. Put in there, what's some cons to property? Stefan already put not liquid. Come on, anyone. Chuck it in there. Interest? Yeah. Is that all we're getting, guys? Come on, man. Got not liquid and interest. Give us one more. Someone. Fucking tough crowd. All right, so big investment. Yeah, so it is a big investment, right? So some of the big cons, you can go backwards. Yeah, 100%. So some of the big cons behind property, without a doubt, the biggest con is that it's lumpy. Yeah, it's a fucking lumpy asset. Now, we tend to have short memories. We tend to think, in good times like now, when property's walking out the door, property's easy to sell. Fucking ask people 6 months ago who were trying to jump on the back end of that the last wave, right? Ask people during the GFC, like it is good it's easy to sell when it's easy to sell. Yeah, but it's a very up and down thing. When property's hard to sell, it's fucking hard to sell. It'll send you broke very quick, right? Send you broke very, very quick. And that's what I say about you can't break off the living room and live, right? So if you're desperate and you need to sell that property, you're up shit creek if it's a bad market. You're up shit creek. You're taking a loss or whatever. You can't even, if you have shares, right? If you have shares and you can't afford to maintain the market, you don't have to sell the whole portfolio. You can drip feed. You can sell as much as you need, and fingers crossed that things pick up before you sell the whole portfolio. Now, to Marcus's point that you can rent rooms out, though, of course you can. You can rent rooms out, but that still might not be enough, right? If you're trying to sell the place and you need cash quickly, it is a really hard asset to sell in bad times, and it's very, very lumpy and can fuck you up very badly. So that's its biggest con by far. Secondly, it can be hard to sell. On the back of that, it can be hard to sell, right? We do hear about quick clearance rates and all that stuff now, but you ask anyone that's had property for a while, and most people have had a property that's been hard to sell at some point in their life, and it's a fucking nightmare, right? It's an emotional roller coaster. It's a financial disaster. When it's not a good market, it is very, very hard to sell property, and it fucking sucks trying to do it. A con that you probably wouldn't expect, that's also a pro, is its leverage, right? The fact that it's easy to leverage is its biggest pro, without a doubt. but we're so oversold and overestimate the power of property that it's also a con, because people go in and over leverage on shit they cannot afford. And lowest interest rates ever is the great time to smart, well-educated financial people. Oh, soap's turned up. So it is really good for people who are well educated in the money systems and who can, look after themselves, right? Cheapest money ever, great time to leverage if you're smart. What does that mean though? It means for people who aren't smart and people who don't understand finances or economics 101, they're going to borrow at all-time highs of money they can't afford because it's their last dig at life. They're going to borrow all-time monies on shit they can't afford at lowest interest rates ever. When interest rates go up, they're fucking cactus, right? And no one's going to tell them otherwise. They're not going to pay for a financial advisor. The bank's not going to tell them otherwise. The bank's going to go, you said you could afford it. Guess what? We're going to take you home. Thanks, heap champion, right? That's what's going to happen. And that's why it's its biggest pro. And it's also its biggest pro. Our biggest con, sorry. We also found that out in GFC 0.1 or 1.0 was when Storm Financial did the double leveraging I spoke to you guys about last time, right? Is so easy to leverage on that people thought it was risk-free and they were just borrowing money against their homes left, right, and center, and boom, boom, boom. Next thing you know, they're all broke. Next thing is we're unsure of future wants versus needs, right? I said this a few times ago. You look back to 50 years ago, people weren't buying in the same places they're buying now, right? I told you the story about my grandparents. They picked up and moved from fucking Little Beach or Maroubra, whatever it's called. They picked up from there and moved out to Mount Druitt because that was safe. That was away from the water. That wasn't war torn. Who knows where the next generation wants to go, right? Who knows where they want to go? Who knows what they need? We're hoping we know. We're speculating, and we can pretty much guarantee almost where it's going to go, but who knows, right? If it switches up, you could be fucked. And then lastly, innovation, right? The property market is fucking ripe for the picking. Ripe for the picking, right? It's unaffordable. Housing is unaffordable. Jace, you talked last week about innovation funds, right? You should see how many projects are going on in the housing system at the moment they're trying to get approved. Housing's unaffordable. People don't want houses, right? Like the next generation, they don't really want houses. They like the fucking, what's it called? When you live on fuck all, what's that called? Anyone? No, I would say limitless. It's not limitless. It's fucking minimalist. That's the one. So they're all minimalists, right? They want tiny homes and shit and eco-friendly homes and all that stuff. Our houses aren't eco-friendly. Building a modern day house is not eco-friendly. You just look at the inflows of money going into ethical and sustainable funds on the share market and the age bracket they're coming from, and you tell me they're still going to be driving petrol cars. Look at Tesla, right? You still tell me they're still going to be driving petrol cars and building fucking non-environmentally friendly homes. Not a fucking chance, right? Not a chance. I don't know in how many decades it's going to be, but it's coming. And the property market is ripe for innovation, not only from an actual housing solution side of things, but also from how to purchase, like these big 30-year loans lending, it's not sustainable, right? They're cancelling the production of petrol Audis in 10 years, I'm pretty sure. There you go. Right? So you've got to understand this. People just think it's guaranteed. Property will double every 10 years. Fucking wake up to yourself. Your property cannot double every 10 years. It's not going to, there will be no one buying properties. There'll be one person in the world who owns all the properties. Right? I can't get to that stage, even though it's fucking close. So innovation for me, looking at it as an investor, as a purchaser, innovation is probably my biggest concern in the property market. But the downside to that is we never know how long, right? We never know how long. But just drive around to your local construction site, right? Look at how many years builders and stuff have been doing shit for the same way for how long. It's just tried and tested. There is, from how you build to what you build to how you fund the build, the property market, the industrial market in general is ripe for the picking innovation. And to me, that's my biggest concern on why I wouldn't hold a huge leverage portfolio of property, because I think something's got to give, right? Something has to give. If you just think at it from a common sense, practical way, and you look at all the other asset classes and how they've been disrupted by innovation and technology, property has to go next. Has to. Anyone got any thoughts on that?
I just have a quick question in regards to Tesla. Is that very is it very overvalued?
We're talking about property today, so.
No, but I heard Tesla. Is it true it's quite overpriced considering all like the metrics?
Depends. You got two. I'll answer this, and we're not going to talk about shares again. Today's about property. But yes, Tesla is fundamentally or technical, from a technical analysis point of view, it is substantially overvalued and has been for years. But the one factor that people don't factor in is a person. You always factor in people and leadership into evaluation on a company. And Elon Musk is a phenomenal human being, apparently, and that's what's driving the price. It's all based on one person. But fundamentally, everything else, yes, they're tremendously overvalued, but they keep proving us wrong. Either he's going to come out as the next Ja Rule and Tesla will end up being the Fire Festival of fucking stocks, or he's a genius. Who knows? You speculate however you feel necessary on that stock from there. I don't hold it for that simple fact because I have no fucking idea whether he's full of shit or not. But I like the bloke. He's pretty funny. All right, so next one. So let's talk about PPR. So what's a PPR? PPR is a principal place of residence. It's where you live, right? It's your home. It's the tax-free, capital gains tax-free place or home that you own. You know, you can only have one of your properties in your portfolio labeled as a PPR for tax purposes. Generally, it's the one you live in. You need to understand that your principal place of residence is just a roof over your head. Yeah, it is just a roof over your head. That is all it is. Okay, that is all it is. It doesn't do anything else. It just provides a roof over your head. And how luxurious or lavish you want that to be, that's up to you, right? It's up to you. It doesn't matter. It's no one's here to judge. But at the end of the day, that's what it is. It's not an investment. Yeah, it's not a fucking investment until you make it an investment. When you buy it and you live in it, it is just a roof over your head, a bit of security, a security blanket to make yourself feel good. That's it. The interest component you pay on a mortgage that you live in is roughly the same amount as the rent on that same property. Yeah. Then you've got to pay the capital depreciation, or you got to pay the I'm struggling tonight. You got to pay the principal repayments on the mortgage to pay down the actual debt itself on top of that. Plus you've got insurances, rates, renos, all that stuff, right? So when people say it's cheaper to be able to pay off somebody else's mortgage, it's cheaper to buy a mortgage than rent, that's fucking not, right? They're both, whether it goes to a tenant, whether your rental income money goes to someone you don't know or your interest goes to a bank, it doesn't matter, right? It's the same shit. But to give you an idea, the reason that is because that's how landlords gauge their rent. Right, it's not a weird formula. That's how they gauge their rent. They want their rent to cover their costs, so they can just pay down the capital component of the mortgage. That's what it is, right? That's how rental returns are figured out. They can still negative gear it. They can cover their costs. It's not going to cost them. That's how the rental market is really gauged in Australia. It's not rocket science, right? So people will say, no, it's not. I can buy I can get a mortgage for cheaper than I can rent. Yeah, because you're going to get a mortgage for somewhere in bumfucking Idaho while you're renting on the east. Of course, it's going to be cheap you do that. But if you're trying to rent the same place, let's get a mortgage on the same place. That is the formula. That is how it works. Yeah. So saying all that other shit about how it's fucking a waste of money and all that stuff, it's not, right? The yield is low, right? So your yield is low and not guaranteed on your PPR, right? If you want to argue that, you can, but we did this the other week, when I broke down owning versus investing. Yeah. After all the interest you pay, the non-deductibility of it, and you break that down over time, generally the yield over 15, 30 years, if you don't utilize it smart, is pretty low. Your growth isn't great. It is just a forced savings goal. That's all it is, because it's not doing a lot more than that if you're paying down the minimum over the minimum recommended time. The rent is dead money argument. That's dead. We just said that. So you need to make sure that you don't have that thought in your head. Does anyone hand up if you still think rent money is dead money? Stefan, let's converse about it. This is be a good lesson for everyone. Tell me why. Why do you think that?
Well, I don't know. So say you were renting a place and another person was renting, owned their place right next door. That was essentially the same house, and they were paying the same price. Isn't one, although they have a mortgage, like they still have an asset and it increases in value, but the people renting, they wouldn't.
So this is a great point because this is the typical argument, right? Let's break it down. You're wrong, but your thought process is right.
Okay.
But you're fucking wrong. No, I'll show you why, right? I'll share my screen. I'll go to Excel. Kingy on the Excel. So the reason that's wrong is, like I said, right? If we're going to buy the same home, let's call it $1 million. Yeah. And over this one, we own it. And over this one, we rent it. Let's just go year to year basis, right? That mortgage is going to cost us $25K per year in interest. Yeah. And then we've got to pay essentially probably another $10K per annum in capital payments, right? So $35K a year. Probably closer to 40, to be honest, probably closer to $15K per year. On top of that, we've got the maintenance cost of a property that price, we're probably looking at just under 1%, so we're probably looking at about $7K per annum to maintain that property. And we'll just leave it like that, right? Just leave it like that. We won't add anything else. Nothing goes wrong with the property. It's fucking mint, right? So that is a total. What? Why isn't that working? Someone tell me.
Put K per annum.
Oh yeah, good one. Good one, King. You fucking imbecile. Should just use the one that I've already done. Why am I doing this? Right. So in total, we're paying $47,000 a year into that property, Stefan, right? On average. Yeah. That rental property, realistically, probably cost you, I don't know, how much do you reckon it cost you a week, people?
Like 250. All right.
650. 250?
Oh, I'm assuming there's multiple people in the house. I don't know.
No, one person. Let's say one person, right? The total rent of that place. Let's say that's probably going to cost you about $550 a week, yeah? $550 a week. So let's just round it up, call it 30K. 30,000. So out of this money here, yes, dead money. Yeah. Now let's not even factor in the fact that a component of your rental could be tax deductible to work from. Let's just forget that, right? 30,000 is the number we're trying to beat here. So on this side, Stefan, if we're paying 47,000 towards that property, how much of that is dead money?
Well, I don't know, however much the value doesn't get to it.
Right. So
yeah.
This money here goes to the bank in interest. Is that dead money?
Probably, yeah.
Yeah. Well, it's
I'd say so.
Right? It doesn't do anything for you. It's just going to the bank as an interest.
Yeah, I'd say so.
Right. This money here, right. Maintenance, council rates, insurance, is that adding any value to the property?
No.
No. So really, this money here is the only part that is winning, right? That is actually adding value to your situation. So out of 47,000, 32,000 of it is dead money. Yeah.
Right. And what's that 15K there? That's the
that's the amount you're actually paying the debt down by.
Yeah. Okay.
Right. So this number here was actually 28,000, but I rounded up to 30. But we'll use that because it sounds better. 28,000. That gives us a $4,000 difference between the dead money on the property and the dead money on the rental, right? So if you're the same person in both scenarios, as long as you invest the same amount that you were going to contribute to paying off the mortgage, which apparently you can afford, so you should be able to do it, you're actually $4,000 a year better off.
Right.
And you can live wherever the fuck you want with with all flexibility, right?
Right. Then that's over a year.
That's just 1 year, right? Just call it year by year, right?
Right.
So you're not completely wrong, right? You're wrong in the fact of that theory, right? But this is why I say to people, it's not dead money. Rent money is not dead money because there's heaps of dead money in a property as well. Yeah, heaps of it. If you were to pay your rent and invest the amount that you would otherwise pay down the capital, you will be in front long term.
Yeah.
But there are cons to that you don't weigh up in a formula. And that's stuff like you have a family and you don't want to keep having to moving houses, your landlord sells on you, that kind of stuff, right? That's why I still recommend we buy homes. But on paper, financially speaking, rent money is way better ahead than if you're to buy and live in a place. Now, the best scenario is to buy, send someone else in there, pay it down on top, then you got best of both worlds, right? Nikita, you about to say something?
Yeah, I just had a question.
Yeah.
So the reason that I always thought that like rent money is dead money is because I always considered buying something afterwards. So I was like, well, why would I pay someone else if I'm going to buy something myself? But would it be like, is that a thing you can do like rent for your entire life?
100%. It's called rent vesting.
Yeah, so you'd have to then and have someone renting out one of them, or
So we're going to get to this in a second, so I won't go too much into it, but rent vesting is on paper the best way to make money by far, right? Because year by year, any home, pick any home that you want. Year by year, the cost to rent that place on a year-to-year basis is cheaper than what it will cost you to buy and pay a mortgage. But can anyone tell me what the different factor in that is? Why that's not what we do? Why we don't just recommend people rent and invest their whole life?
Well, one is like what you just said, right? Because of the life challenges.
Let's talk about financial. Forget life for a second, just financially.
Well, I don't know, the asset goes up a lot of money. If you own the home.
Yeah, so no, forget owning it. The asset goes up. What also goes up when an asset goes up?
The leverage?
Nope.
Interest?
Nope. The rent. Okay. So the thing is, if you're to compare renting in 1 year to buying any house in 1 year, renting wins. Yeah. Where buying wins is because you're buying it at today's price and paying it off at that rate. So it might be worse off for the year, but in 5, 6, or 7 years, it's likely to look better than if you were to rent at the same time, if you are paying that property down at the right rate. This is why we said in that first session, 15 to 20 years is a good number because you can get in front of the interest curve, which makes it a better option than renting quicker. Yeah. Where it fucks people up is they pay the minimum for 30 years and they never get in front of that interest curve and they can't capitalize on it. Yeah, it doesn't work. Now, Nikita, to your point, it is good to own something, right? Why would you do it? But like that spreadsheet just showed, at the end of the day, if you've only got 15,000, what's the difference between paying a mortgage to the bank for 30,000 that doesn't do anything and then you're only actually buying the house with that 15,000, right? Versus paying rent to someone you don't know and then investing that 15,000. What's the difference?
yeah, I guess the only reason I thought of, that it would be different is like when you're old, you've paid off your home, you don't have to worry about it. Maybe
100%.
you can't afford the rent or something like that.
100%. But remember, guys, this is like episode 1 shit, right? Remember, by the time that you can no longer work, we need 2 things. What are they?
Super.
No, more general.
A place to live?
A place to live. You need a roof over your head, and what's the other one? Money to live on, right? That's all we need. Break down any expense you have. They're the only 2 things you need: a roof over your head and money to live on. Now, Australians, we're so fucking retarded that we focus on, we need the roof over our head, and we don't focus on the actual money to live on. So people get to retirement, what are they doing? They've got to sell the roof over their head to fund the money to live on. But in theory, if you have enough money to live on, you can continue to pay for a roof over your head, right? If you can afford to rent for the rest of your life, it doesn't matter. It's just an ego thing that you own the house or not. But on paper, yes, Owning your house by retirement, if done properly, as well as funding the income you need, is a much more financially safe way to do it. But it shouldn't be the priority. That's what I'm saying. People think that 47,000 is them buying their home. It's not. They're only buying 15,000 of their home each year. The rest is dead money. So they're only investing 15 grand a year and think that that's all they've got to do. By the time they're 60, all they've got is a roof over their head. What do they do now? We don't have to pay rent. Great. We've still got to put food in our mouth. We're still got to pay the rates and the insurance on the property. That's why it's important to understand the whole picture and not get cemented into rent money's dead money, I must buy. What you must do is whatever it takes to achieve all of your goals at the same time. Yeah. Not just, I've got to buy because rent money's dead money. That's a retarded way to think. That is 20 years ago way to think. We've got to progress on from that and understand what our options are and align our options with what we want to do. Yeah, that's what this whole course is about. So if you take anything away, that's what I want you to take away, right? Don't get caught up in any of these fucking things that people are saying that this is what it is, this is what it is. You know all the options now. How do we align that to what we want to do? The only valid argument for property, like buying over investing, literally the only valid argument is security. That is it, right? Is that I don't want to pop up and move, or I like to have my own place, or I want to renovate, whatever. That is the only valid argument. Anything else is invalid. Anything else I could debunk with an investment plan, right? The only reason, and you can ask Marcus, you can ask Westy, ask Damo, ask Josh, ask Jace. The first thing that we talk about with all our clients is how we're going to buy that forever home. It is the first thing we talk about, right? It is such an important factor because it works. But how we get that, the process to get there is a different conversation than just buy it now and that's what we need, right? We've got to make sure it fits into everything else because the last thing you want to have to do is sell the dream home to fund the average life. Yeah. The other big thing that is a big thing with your PPR, your principal place of residence, is it's forced savings. So sometimes we will recommend a home for people because they're so shit with money, they need something that makes them save. And that is a really, really positive outlook on property. That's one of its biggest benefits, is it forces people to save. The last one with principal place of residence, the almost risk-free moneymaker, is if you're a flipper. Yeah, if you're a tradie, you know how to flip good. Not if you're like me, who doesn't know which way a hammer is supposed to be held up, and you try and pay people to flip, you end up doing your ass, right? If you're a tradie and you know what you're doing, you've got friends that are all tradies, you can do a good job. Flipping is a great way to make money in any market, but you've got to be good at it. Any questions on principal place of residence before I move on to investments? No, beautiful. All right, so investment properties. So we've got tenancy risk. That's a big risk with investment properties. We've got tenancy risk, as in the risk of tenants not being able to pay. Everyone thought that was a myth until COVID hit, and then fucking left, right, and center, right? And this is why it's really important to always play the worst case scenario up front. You can leverage hard into investments. Now, not so much these days as much, but you can technically leverage more into investments because you've got extra income coming in. But you've also got to pay for your rent as well, which is a downside as well. Negative gearing, great way to build wealth tax effectively. You can get into investments with low deposit. It's always good as well. They've got the 5% and even the 2% schemes for some divorcees and stuff like that. But I usually don't recommend to get in with less than 10%. Just because you can get into the house doesn't mean you can afford it. It's good. Investments are always good for people who don't know what they want to do, like investment properties. I don't know what they want to do or are not in a position to buy a dream home. The biggest benefit about an investment property is that you get your foot in line with the market of something we know we need later. Whether that market goes up or down, it doesn't matter because at least you're in line with it, right? If you're in the market and the property goes up, well, your property is going to go up. So at least you are in line with what you want to do later on. If it goes down, it doesn't matter because yours goes down as well. It's all relative, right? That's the biggest thing with investment properties, being able to align yourself with something you know you're going to need later on. We'll get more into this in a minute too. Commercial property, bit of a niche. Commercial property, where all the businesses are, can be a great asset or a really bad one. It's a really high risk, high reward kind of strategy. When we talk about income in property, commercial property has the best income, right? I know we used to have a client that owned an entire street there's one street in Orange of all the businesses. He owned that whole street, and that was his retirement income. And then he tried to sell them, and he went fucked. But commercial property can be a great asset, especially for business owners who want to buy their own office and rent from themselves, and then consider an SMSF for that as well. Commercial property is great from a rental space. Not so good on a capital growth space in the small areas until you get in the city and you look at the big high rises. But from a rent yield, so outlay versus income, brilliant. But you have higher tenancy risk because businesses fail often. Yeah. But if you can get big leases with big companies, fucking brilliant little investments. Generally good for people with larger money to invest to buy bigger assets in good areas. You ever know how risky a commercial property is? Walk through the city, I don't know, every week for 3 months and count how many times businesses change hands. That's how risky commercial is, right? How often do you walk past places? I don't know what Victoria's like, but walk past places and think, how the fuck are they in business, right? How are they in business? Or that used to be at this, or that used to be at this, right? It happens all the time up here, especially in the city. Commercial properties are crazy risky. Then we've got property funds. So we talked about this in the other one, which is investing on the stock market in property funds through companies like Charter Hall and stuff. Generally, they are companies who do infrastructure and they build your big high rises and stuff, and then they sell that property in units, like a business essentially, and you buy units in it and you can trade in it on the stock market. That's really property funds in general. Buying a unit trust and you get shares of the ins and outs. And then we got your little ones like BrickX and shit. BrickX blew up when it came out. It was a great little innovative idea, but the thing with things like BrickX, does anyone not know what BrickX is? Oh, wow. Okay. So BrickX is essentially a company that came out and they would buy property, like residential, and they'd sell you a brick at a time. So you could own that property per brick, right? It was essentially the exact same as a property fund. So it was just in a trust and you just owned a percentage of that trust or units in that trust, but they called it bricks, right? You owned per brick. Great idea, right? Great idea in theory. But at the end of the day, stop trying to make an asset what it's not, right? If you're going to buy into components like that, buy shares. You're going to buy small little liquid funds, buy shares, because property doesn't operate that way. Property doesn't operate that way because that's not how everyone owns it. Does that make sense? The property market moves the way it moves because everyone owns it the same way, right? Most people own the same way. Coming in and trying to disrupt that way, it's not the answer, right? It's not the answer because you can't live in your little one if you had to, and you're just trying to turn it into a share, which it's not, and it shouldn't be traded that way. If you're going to buy property, fucking buy property, right? They still go all right, but it's a bit delusional, I believe, what they're trying to do. All right, so what are some solutions? So remember, it's lumpy and long-term. We want to reduce our risk by aligning with a purpose. That's how you reduce risk in property, yeah? You think not? Go and talk to anyone who's bought property in mining towns. There, have fun. I've had to deal with millions of them. Not millions, but literally probably hundreds of people I've had to deal with. And it's a fucking emotional roller coaster I never want to do again, right? It's a joke. All classic property spoofers come around telling them, this is why I hate property spoofers, right? Dealing with miners for so long. So it's lumpy. You need to reduce your risk via aligning with purpose. How are we going to do that? So you always want as little debt as possible on your own home, for starters, right? Whenever you come up with a strategy, you always want as little debt as possible on your own home. So you don't have to, right? Get your foot in the market, sure. But you always want to focus on minimizing the debt on your own home as fast as possible. The bigger the deposit, the better. The faster you can pay it down, the better, right? If you buy your own home and you live in it and you're paying it off for 30 years at its minimum, you're an imbecile and you shouldn't own that home, right? That's a moronic move. But what if the property goes up? Cool. You're still not going to be able to do nothing with it for 30 years because you're still tied up. You're not going to be able to travel. You're not going to do anything because you're living on eggshells trying to fucking earn more money, trying to pay this mortgage off, right? Stupid idea. You need to get that debt down on your own home as quickly as possible so you can use that equity for other shit. And then you want to have more debt on your investments. Now, negative gearing is like what we talked about the other week. It's like you spend $5 to save $1, right? It's a little bit like that. But all things being equal, if you've got debt, you want it on your investments, okay? You want debt on your investments, not on things that don't make you money. That's where you want your debt. Now, once you pay off all your other debt, like your home, your principal place of residence debt, then of course you can start paying down your investment debt because you want that net income, right? You want that positive return. But there's no point paying tax on money that you're going to sit. JB, come on, man. You were in that session, weren't you? Surely. Nikita, you know, Nikita, you did the homework 3 times and sent it to me just to try and get a golden star.
No, but just when you said that, it made me go like, oh, what should it be? Is it
15
50?
to 20. 15 to 20. 15 is ideal, 20 is doable.
Easy.
All right. Yeah, there's no point paying tax on income, right? So if you pay off your investment property and you get the rental income, right? There's no point receiving that income, paying tax on it, and then paying down your own mortgage with it. That's ridiculous, right? It makes no sense, but that's what everyone does, right? Because they want more income. It's fucking stupid. You should be having the debt on your investment property. So the income comes in, it pays the debt down, then you get taxed on whatever's left, and then you pay your own house off with more efficient money, right? With part of the tax return. All right, so I'm going to give you a low risk investment strategy. This is a lower risk, I say. This is our go-to for property, right? Like almost everyone who comes on board that has the same goal, I want to own my home, I want to retire early, we run down this path heavily, right? It's brilliant, it's successful, it's worked 1,000,000 times. It's a great strategy. I'm going to give it to you today. Doesn't mean you're going to be able to do it, but I'm going to give it to you. So I've talked to you guys about this before anyway, but you probably, from what Nikita's just said, you just forget everything I say anyway. So, and she's the star pupil, so it's pretty good. Actually, who's it down to that hasn't missed a session? Alex, Damo, and Nikita, I think. Or what are we gonna? I'm not giving you nothing. I don't care, fuckers. All right, so let's talk about this low risk strategy. So we always talk about we want to buy in line with purpose, right? Watch, please. We always buy in line with purpose, right? And we've got to make sure, what does purpose mean? Well, we know what we want with the house, right? We know what the purpose of the house is. We either want it as an investment to generate a return, or we want it to be a roof over our head. Now, which one do we have more control over? Well, obviously the roof over our head, because we know what we want, right? We know roughly what we're happy with. So step one is we always want to try and get into property first, not because it's better, because it's easy to leverage off that at the back, yeah? Now, we've got a lot of clients that we go into shares first because we're not really ready for property, we're not sure. But if possible, if there's enough money there, we try and get into property straight away, right? That way we can leverage off the back of property into shares and make a lot more money tax effectively, but it's not detrimental. But if we're going to buy a property first, what we want to do is use the backup property option or the fallback strategy, right? So everyone wants to buy their first property and they'll go to a buyer's agent or some fucking cocksucker and they'll say, yeah, buy in Brisbane, buy here, buy there. And like they have a fucking crystal ball and they know what's about to happen, right? Brisbane's been getting pushed down investors' throats for years and it's still just trickling along behind Sydney and Melbourne. What you want to do is with your first property, I urge you to really take this into consideration, is you want to look at where you think you want to live, right? Where you think you want to live long-term, right? Just roughly, right? Find something as close to that as possible, as in as close to that location that you can afford. That's also a good investment option. That should be your first purchase. Why? Why should be? If someone tell me, why should that be your first purchase?
It aligns with your purpose or goal.
Yeah, but tell me more. Break it down. Why? How does it align?
You can move into it if you need to.
There we go. There's one. Yeah, fallback option, but why? Why? So we can move into it if we need to. So let's just cover that in a second. So the reason it's good is we're not going to move into it. It's not our dream home, right? But we know that if shit hits the fan, we've got our foot in the market and we can just move into it and pay that down. Yeah. We've bought it at an early date. So it's going to be cheaper than rent in 5, 6, 7 years. So if shit hits the fan and our life's not going as good as we can, we're happy to move into it and we've just saved ourselves. We've just double entered that property. We've given it 2 purposes, right? 2 fucking purposes straight away, which reduces the risk significantly rather than just trying to make money. What's the other one? What's the third one?
I guess if it's ideal for you, it's probably ideal for other people as well.
Nah, so that's a good point, Nikita. That's not a bad point. That'll make it a good investment. But let's think about it in relation to the purpose of your home that you want in the future. Remember what I said? You want to buy it as close to it as possible that you can afford, right? Why? Why would we do that?
Because it'll go up and you might be able to get a better place closer to where you want when you want to retire.
Grows with your future home. Jace nailed it, right? If you buy your investment property near where your future home is that might be out of your reach, right? That property, whether your dream home goes up or down, Mark is telling me that. Yeah, because I think he did it like a week ago. That property is going to go up and down as well, right? Your investment is going to align with your future home. So regardless of whether it goes up or down, you're going to have your foot in line with that market, yeah, in a relative sense. Now, the other good thing is upgrading is always great in downwards market, right? If you've got a place and you're building equity in a place that's near where your forever home wants to be, let's say your investment property is $1 million, just using round numbers, and your dream home's $2 million, right? If you just keep paying that off and waiting for a down market, if that dream home drops by 10%, how much is that? 1.8, right? But how much we lost? We lost 200 grand. Your investment property is worth $1 million, it drops by 10%. How much you lost? We just made 100 grand. You sell your investment property, you lose 100, but you save 200 on your property. You just made 100 grand by upgrading. That makes sense? Right? Downgrading it, upgrading a downward market is fucking genius. It's brilliant. We've done it heaps with clients, right? And now that's just very conservative. That's 10%. That's you hit that at a 40%. That fucking joint's going to be that. What's that? That's 800 grand you can lose on that property, versus you're only going to lose 400 grand. You just make 400 grand on your upswing on the property, right? Fucking brilliant, right? So having your investment property as your backup option, and just the first one, not all. You don't buy all your fucking investment properties around your area you want. You can if you want. That's fucking crazy. But the first investment property as your backup property gives you so many options moving forward that it's very hard for that property to fail. Yeah, you're ensuring that property has so many purposes that you have to get real unlucky to not win with that property, versus just buying something in Brisbane that someone told you and hoping that, yeah, hopefully that goes up, fingers crossed, and then holding it for fucking 30 years and nothing happens, right? You need options. So once you do that, so we buy. Does anyone have questions on step one? Buying fallback strategy. Does that make sense to everyone? Yeah, cool. So we buy the fallback strategy, and then the second one, you've got an option. You can diversify off into shares if you want, and we do that often, or you can get another property for leverage points, and that second property should be really either. Let's say you're someone who's got a couple of places you want to. So me, right? Me, for example, so I'm a rent investor. I rent, I invest, right? Next year, we're probably going to buy our first property, and we're probably going to go straight into our dream home. But before that, my strategy was rent vesting, and my rent vesting strategy was going to be, because I didn't know whether I wanted to be in Victoria, I didn't know whether I wanted to be on the sunny coast, I didn't know whether I wanted to be in Townsville, I didn't know whether I wanted to be out west, I didn't know whether I wanted to be on the Central Coast or the beaches, right? So our strategy was going to be to buy investments one by one in all of these different areas, right? In our most common different areas, so that we had multiple fallback strategies that were also good options moving forward. Now, we're not going to do that now. We're going to go buy probably a farm, because I'm big Westie scumbag. Go buy a farm, raise some fucking horses, not speak to people. Sounds like a dream. But we're going to go do that, and that's going to be our plan, right? But before that, rent investing, that's what our strategy is going to be. So it doesn't have to be about making money all the time. You can align a really easy strategy with all these things you want to do, even if you're not sure where you want to go. Once you do that, once you secure kind of the places you want to live, then if you want to go down the property route and keep going down, then you can you can just look for money, right? Look for places to money. You've got a bit more experience. You can start looking at places that might be able to grow. But my one recommendation is don't try and speculate with property, right? Don't try and speculate. So the number one truest to God fucking property winner is blue chip areas. Blue chip areas, right? Train stations, central hubs, always go. Speculation is saying if you go to somewhere and you throw a rock and it lands on a paddock, right? And you say, this is going to blow up. That's speculation, because you don't know how long until the community moves out there. Now, sometimes it pays off big and it's mad and it's hectic and risk versus reward, you make lots of money. But I've seen a lot of people go broke doing that. You will never go broke in blue chip suburbs. Why? Because especially really blue chip suburbs, you think about places like, I don't know, maybe I think Toorak in Victoria's Toorak, real blue chip. That's one, right? People in Toorak don't care what houses cost. They don't give a shit because if they want a place, they're going to buy it. Yeah. Your price is never going to go down because you go in there and someone tries to haggle you, go fuck yourself. Someone else is going to come in here and pay, right? People in those areas will pay what they have to pay because they want the place. Yeah, that's why blue chip wins. Now, as you go from superior blue chip and dwindle down, it gets less and less, right? Because people do have affordability issues. But the more blue chip something is, the more long-term strategy the more long-term benefit you're going to have. But as long as you lock that in, you can speculate a little bit on the back end with other ones. But I would generally go fallback property, secondary property, maybe a third property, and then definitely be just diversifying into shares. You don't want to get too held up in property and cop it all in one go. All right. For principal place of residence, you want to buy, when you buy, your focus should be trying to rapidly pay. So remember, first step, buy and own within 15 to 20. But then you should be rapidly trying to pay off 70 to 50% LVR. Anyone by now not know what LVR is? Loan to value ratio. So loan to value ratio where if you've got a 70% LVR, it means you've got 70% debt, you only own 30% of the home. Yeah. So if you put a 10% deposit down, you've got a 90% LVR. So we want to rapidly get to 70%, right? Now, obviously the home should grow and your principal payment should come down. So the quicker you can get to 70%, the better. Marcus, that's the ugliest yawn I've ever seen in my entire life. I honestly thought you were about to throw up. You guys not even listening. He's moving on. We're moving on. All right. So you want to pay it down to 70%, maybe, and if you can get to 50%, even better. But 70% should be. JB's in. That was Nikita. That's weird. I saw Nikita type that. That's strange, man. Come on, we're going off track. Leave me alone. All right, so we'll pay that down because once you get to that position, that's when you can start utilizing your equity to look at debt recycling strategies and tax-effective options to get ahead quicker, right? That's why that's important. You should really try. It also gives you a buffer for emergencies, refinance, anything like that. And then you can start leveraging within your risk parameters to build your passive income retirement portfolio. It's the easiest way to pay off your home and retire at the same time. And then the last one, rent vesting, right? So if you want to stay renting, the thing is, when you rent vest, you have to invest on the side. Just rent. This is where people do my head in. No, I'm a rent investor. What are you investing in? Or nothing yet. Oh, okay, cool. And they have a chat with you and they're like, no, I'm not buying my home because I'm rent vesting. Renting's not dead money. Kingy said so. Yeah, but what are you doing? Like, you've got to be investing at the same time to actually say rent money is not dead money, right? You have to. Otherwise, yes, it is dead money because you're a drop kick and you just spend your money every weekend and telling people that you're going to buy a house next year and you do that for 5 years and you never buy a house, right? We all know those people. So rent vesting is great, but you've got to actually do it. The alternative strategy to that with rent vesting. So Nikita, back to your point about buying, could you rent vest forever? Yes. One strategy some people will use is, I know a lot of business owners will do this as well, but one strategy people use is you rent vest, right? So you rent, maximize your superannuation contributions, plus investing on the side. And then if worst case scenario comes, by the time you hit retirement, you can pull out some of your super contributions to pay whatever you can't afford left on your debt or whatever, right? So you supplement by that. All right, so what are our takeaways and execution? So takeaway number one, understand purpose. I can't say that enough. Understand purpose, especially behind your properties. Why are you buying the properties? Is it just for money? Fucking forget it, right? Align it with actual purpose because you don't know whether you're going to make money on it or not. And you're going to be the first one that plays the victim when you lose money and say, oh, but property always goes up by every whatever, right? That's you. It's on you. You took the risk. Takeaway number two, the interest and cost you pay on a home is also dead money, not just the rent. Okay, remember that. Takeaway number three, consider your options, right? We've been through a whole fucking 14 weeks now of all the different options that you can do to get ahead in your financial thing. Don't just think property is the only way. It's a great way, it is, but it's not the only way, right? I see as many people go broke as I do get rich off property, if not more, right? Because people are idiots. Don't think what you see in the media is the only way. Consider your options. All right, so execution items. So again, a bit of homework that I'm not going to chase you up on. We're getting towards the end, but this is some stuff that you can do that will help. Number one, analyze what your dream home looks like and what your fallback option is, right? Start looking at, well, if I want to live here, where are some things that my first purchase could be, right? And can you afford either? If not, you probably need to start investing. If you can afford the dream home, we'll have a look at that. If you can afford the fallback option, consider that, right? Execution item number 2, sit with yourself. That's it. That's the homework. Sit with yourself. We all struggle with that, right? Sit with yourself and figure out if you want the house for financial or security purposes. Yeah. Actually, after today, sit down and talk to yourself about, do I want a house because my whole life I've been told that's what you need to be successful, or do you actually want the house because it means something to you to be secure, etc. Right? Like, this isn't on me. I don't give a shit what you answer, but you need to sit down and figure that out with yourself. Get rid of all the bullshit that your parents and everyone around you has passed on to you over your whole life, and actually sit with yourself and think, do I really want a home, or is it just what's being pushed on me that I think I do, or do I really want that security? If you want that security, great, but sit with yourself and actually understand what you want to do for you. Number 3, start putting your next foot forward on the path that fits for whatever you decide. Yeah. You do want a home, start saving, right? Start getting that together. If you can't save in the next 3 to 5 years, start investing so that you can then get a home, right? But start doing something about it. Home prices aren't coming backwards anytime soon, right? Like, dramatically. They're not getting cheaper, and you're not getting younger, and interest rates aren't getting lower. So start putting your front foot forward and getting on track to figure out what you want to do, and then start working towards doing it. That's it for today. The next session is bringing everything together in the finale. So a little bit of how to construct a financial plan off the back of what we've done. It's pretty basic. It's nothing great. It's just to wrap it all up, but it is what it is. Anything anyone wants to add before I let you go? Yeah, hit me. Let's go. Questions.
I watched The Big Short last night. Scared the shit out of me again.
Great movie.
Is our like mortgage market similar?
Not even
Not
close.
in ratio wise, but is it built the same at all?
No, not even close.
Yeah, because I just don't understand the complexities behind.
So we didn't face
the loan.
Yeah, we didn't face the same GFC that they did, because we've got a regulator in place. We've got ASIC and we've got APRA, right? APRA's job is to go around and make sure that the banks have enough money in cash so that something like that can't happen. Now, it could still happen, but the property market would have to fall like 100%. You know what I mean? It's unlikely that what happened there, but it's always a risk. It's always a risk. They also thought Lehman Brothers wouldn't do it either, but they did. But some companies have got trash mortgages backed up like that. So Nicole's not on today, but she mentioned last time Liberty or something. No, she mentioned like a bond fund, Liberty or something like that. What are they called? Does anyone know? They always advertise.
Latitude.
Latitude. There we go. So there's like Liberty and Latitude, all those ones, right? And that's what they do. They package up shit ass bonds and they like debt into a bond, and they charge you an arm and a leg for it. And you'll have, if you ever have gone for loans, you'll get 2 things. You'll get a low doc and a full doc loan. Full doc is like a normal bank where you get a low interest rate because they ask you heaps of questions. Low doc is where they say, yeah, rightio, we'll take you on with only a couple of documents, but we'll make you pay a higher interest rate. That's their risk, right? They'll take more money off you because it's riskier for them. That's those, but there's not a lot of them in Australia, but with mortgage brokers, it's starting to be, but it's definitely not as risky. It's still a risk, but definitely not the Big Short kind of stuff.
Are they the ones that are offering lower interest rates as well?
No, higher interest rates.
Wow.
So if you can't get lending somewhere, they'll be more likely to give you lending, but you have to pay more for it.
Yeah.
Anyone else? Come on, more questions. Come on.
I want to know about the size. So I read something the other day. The housing market in Australia is like a $2 trillion business, and shares is like $1 trillion. Is that accurate? And is that representative?
No idea.
Anything?
We can Google it. No idea. Super is like, we got to think super is like 3 trillion in its own, right?
Yeah. So outside of super, it's like one of the biggest. Well, I was just like, is it too big to fail until it fails?
I don't know, man. I have no idea. Personally, Maz. Hey, Maz. What a legend. Maz is a living legend. I only have Marcus on as a client because of Maz. You'd be in trouble otherwise. even though he does all the paperwork. No, so I don't know, man. I have no idea, right? Like, you got to remember, guys, as a financial advisor, my game is strategy, right? I don't really know, like, to the nth degree about property and shares what's going to happen. I'm speculating as much as the next. I just use educated analysis on top of it. But people aren't rational. That's the problem, right? That's the problem with investments. Is people aren't rational. People as a general topic are retarded, right? We're spastics. People doing shit they shouldn't be doing. And that's the scariest part. Is we talk about Tesla being overvalued. Property is the most overvalued asset in Australia. You look at the ratio of income to ownership, and it's fucking ludicrous, right? Like, we can't do it. But and my theory is always that I would love to see the government stop property as an asset to invest in. You know, you can only own it to live in it, and that's it. That's what it should have always been, but it's never going to be that way. I don't know if it's too big to fail, but I will stand by my sentiment that it's ripe for the picking for innovation. Something has to happen. In 20 years' time, 3 people are going to own all the properties in Australia, right? It's just, you won't be able to grow that way. We won't be able to grow that fast, and we'll have more homeless people than we know what to do with. It'll lose jobs, we'll lose, industry will die. So there has to be something, but I doubt it. I doubt that the rich people in Australia are going to allow something drastic to happen that it fails, right? It just won't happen. But there will be something that will stagnate, that will have to recourse the property growth, because it is at the end of the day, guys, it's like, imagine if water becomes so expensive people couldn't afford it. Fucking wouldn't happen, right? Like, something's got to happen. But until then, like, and they like, it's still a safe bet to buy as an investment, because they can't just turn it off. They can't be like, oh, you bought all those properties because it was going great. Guess what? They're not worth anything anymore. It can't happen, right? But something will have to come in. There will have to be some form of innovation to fix it up. And that's the biggest risk I see in the property market. But I have zero idea what that looks like. And therefore, I'm not going to speculate any further on it. Anyone else?
Yeah, actually, I had one. It's not about property though. It's about investing. I was wondering if you had any experience or know of anyone who, say, they get personal loans, and they use the money to invest.
It's illegal.
It's illegal.
It's illegal, yeah.
Really?
Yep.
So you can't just get a loan and then put it into something.
No, there are very strict guidelines behind what you're allowed to do with that personal loan money.
Oh, right.
And for financial gain is not one of them. But people do it. There was a big strategy back in a little, it's hard to regulate when we're talking a couple of grand. There was a guy that his whole business used to run on, go get a $20,000 loan, use the first home buyer grant, like a personal loan, use the home buyer grant, dump it into a property, fucking do this, that, and the other. And it was his whole business strategy in about 2013 or 14. And he made millions on it. But it's very unethical and very frowned upon. And part of the banking regulation that's come in is to crack down on that.
Oh, because I got a mate that just did it. That's why I was asking.
You're not even allowed to get a personal loan and put it into your business. You can, like you do. When I say you're not allowed to, like, fuck, you're not supposed to do cocaine and ice either, but there's heaps of people doing that, right? But you can't, you're not supposed to, but it happens. But you got to understand it is illegal, like it is risky. Because they've got facilities, there's actual facilities for investing, right? Because it's from a risk perspective as well, right? Because you're telling the bank, you've got to tell the bank what you're using that money for. Because you've got to remember, they're not just handing out money, right? They're giving you money as a business so that they make a return on it. That's what lending is, right? So when you say to them, I just want 20 grand, they think it's for a car, or they think it's just for you to use for whatever. Yeah, he's probably gonna pay that back, right? Like, he's probably just gonna pay it back. It's not incurring any extra risk. The moment you say you're going to invest that, they go, whoa, hang on a second. Well, now you're going to invest it in something. It could be like, if you go and invest it, you could invest it in Forex, where you can leverage that money even further. So you could double leverage it. Next thing you know, the bank's going to be like, how the fuck are we going to get our money back now? Right? And they're not going to do it. That's why it's illegal. Is you've got guidelines behind what you can and can't use it for, because the bank is taking a risk on lending you that money, trying to guarantee they'll get that money back. Yeah. Things for investment, things like margin loan. So margin loan is an investment loan where you essentially take the loan out, secure it against the shares, and then you top it up. But then you have what we got to understand is when they have what you call a margin call. So you've got to keep that LVR, so the loan to value ratio. You've got to keep that at a certain rate. If your portfolio dips below that, they will do what they call a margin call, and you have to put that extra money in. So you have to have it available to put extra money in to reduce your LVR, to reduce the risk. Otherwise, they'll fold your whole account and take all your money.
And what's the interest typically on those sort of things?
Depends, man. We don't really do margin loans anymore because for me, it's better with our clients to pay down debt and then use the home equity for that. But when we're doing a lot of them 2 or 3 years ago, you're looking like between 5 and 7%. So probably now you're probably looking around that 5 to 6% or so, something like that.
Pretty good.
Anyone else?
Yeah, I've got a quick question.
Yeah.
Is it true properties increasing at a faster rate in outer suburban areas than more inner suburban areas? So people are moving out to the outskirts of Melbourne, say?
Depends who you ask. If you ask your rural real estate agents, I'm sure they tell you it will. I don't know. It's the numbers are so skewed in property. This is the hardest thing about property, is it's so non-transparent because they only report on what's focused, right? On what's focused. So same as for so many years, the amount of numbers of people moving up to fucking Brisbane and doing this, moving that, the property prices never overtook Sydney. It didn't make sense, right? Yeah, property spruikers selling shit. The only time that it's blown up was during COVID in the sunny coast when everyone moved up there because it actually happened. I don't know. It could be a media thing. I do know of a lot of people moving rurally. And you might say that, yes, this is probably my biggest answer to your question, and my biggest argument, is you might say that, yes, the growth rate of the rural properties right now is higher than the city. But if you take that over the last 10 years and probably into the next 10 years, it's not going to fucking be a drop of water in the pond, right? Because it might have one, it's like anything rural. It might have 1 or 2 good years while it's a fad and everyone's moving, but then it stops. So you get 2 years of growth that is actually averaging out its last 30 of no growth. And this is what people forget. They see, holy shit, last year had a really good return. Let's all go buy there, but the growth's gone. The growth's gone, right? They're all trying to buy there and they're sitting on these properties now that they can't get rid of. That's what happened in mining towns. That's what happens rurally. The only fucking reason to buy rurally is if you want to live rurally. I wouldn't invest rurally. Unless it's like a rural hub, like Orange or Bathurst, something like that. They can be really good, but again, they're up and down. Like they go through fads, but they're good long-term sort of rental yield and income. But yeah, I wouldn't invest rurally.
But even like rural, say like maybe 25 minutes from the CBD, so half an hour.
Again, it's proportionate, right? More people can afford this, and more people are going to buy. But just because, let's say it grows by, I don't know, 20% or whatever, right? Versus 10% in the city, the dollar value of that growth isn't going to be as much as the CBD places, yeah?
Yep.
Because they're bigger. And then, but people say, but what, $1 million property in the city, you could own $500,000. But then you got 2 lots of insurance, 2 lots of rates, 2 lots of stamp duty, 2 lots of all your fucking expenses. So it nets out, right? Yes, West might be growing on a higher rate of percentage, but in no way, shape, or form is it going to outperform on a dollar figure what it's going to happen in the East. It's still speculation. You're still going to have to time it and get in and get out at the right time, which is never a good idea. Anything else? All right, fam, I'm going to wrap it up. I always get nervous at this point thinking I haven't recorded the whole session, but I have. All right, I'm going to wrap it up. If you've got anything, let me know. Otherwise, I'll send this out. And then next week, I'll just tell you. No, I won't tell you. Yes, I will. I'll tell you what we're covering off on. Yeah, it's just a general wrap up and overview of everything step by step, what you should be looking at, what you should do, and what your next step should be. All right, reach out if you need me. Otherwise, I'm out. Peace out. Love yous all. I'll speak to you soon, yeah?
Yeah, thanks.